Welcome to Accounting in Focus. In this video, we are going to discuss another type of depreciation method called double declining balance. And if you just watch the video on straight line depreciation, you would know that under straight line, we take the same percentage every year. So we take equal amounts of depreciation. In double declining balance, we're going to use an accelerated method of calculating depreciation. So we're going to take large amounts of depreciation in the early years, and then, the depreciation becomes smaller as we get to the end. So one concept that's really important with double declining balance is the concept of book value. And book value is equal to cost minus accumulated depreciation. Okay, so this is a really important concept when you're talking about double declining balance because we're going to be using the book value in our calculations. So the first thing that I like to do when I'm doing double declining balance is I like to calculate the percentage that we're going to use in the calculation. So in this case, we have a $270,000 piece of machinery with a useful life of 5 years. So if I'm going to depreciate it over 5 years, if I take 100% and divide it by 5, that would give me 20%. And if you were doing straight line depreciation, you would take 20% of the value each year. But because we're doing double declining balance, we're actually going to take that and we're going to multiply it by 2. So you might see in your textbook that it says straight line percentage times 2. That's what they're talking about. So you're going to take 100% divided by the life, which in this case is 5 years, and then you're going to multiply that percentage by 2. So in this case, my double declining balance percentage is 40%. Okay, which means we're going to take 40% of something every year for the depreciation. So since we're doing double declining balance, we're going to use book value. So it's going to be book value times percentage. Okay, and let's run through the calculations for the entire life of this asset so you can see how this works. So if you think about what is book value in year 1, well, it's cost minus accumulated depreciation. I don't have any accumulated depreciation before I actually do this calculation. So in year 1, my book value is 270,000 times 40%, and that equals 108,000 for my depreciation. Okay, so my depreciation for year 1 is 108,000. So now for year 2, I've got my book value would be 270 minus the accumulated depreciation. Well, the only depreciation I recorded so far is 108,000. So I would take 270 minus the 108, so my book value is 162. Then if I multiply that by 40%, my percentage doesn't change. Then my depreciation for year 2 would be 40% of 162, or 64,800. Okay? So now for year 3, I had a book value of 162. I recorded another $64,800 worth of depreciation. So 162, which was the old book value, minus 64,800 gives me a book value of 97,200. Okay, so you don't have to keep, you don't have to figure out, okay, 270 minus the 108 minus the 64.8. You don't have to add the 108 and the 64.8 together to figure out what the accumulated depreciation is. You can literally say, okay, well, this was the book value, the 162, minus the new depreciation of 64,800 gives me 97.2 times 40% equals 38,880. Okay, so that's my depreciation for year 3. So let's keep going. This is a 5-year asset, right? So I got 5 years to go. I've got 2 more years to go. Year 4, 97.2 minus 38,880 is 58,320 times 40% equals $23,328. Okay. Year 5, last year. Okay, so 58,320 minus 23,328 is equal to 34,992. And if I multiply that by 40%, that equals 13,997. Wait a minute. I have an estimated salvage value of $30,000, which means the value of my asset cannot drop below the salvage value. Remember, in this entire calculation, we've kind of ignored salvage value. Well, when you're getting into the final years, this is when you've got to start paying attention to it. So if I look at this, if I take $13,997 worth of depreciation, that's going to drop me way below $30,000. In fact, I can just kind of eyeball this and say, wait a minute, I can only take $4,992 worth of depreciation without going under the $30,000. So even though I calculated $13,997, I actually can't take that much depreciation. I'm limited to $4,992 because of the salvage value. Okay, so if I take $4,992 and subtract it from $34,992, I get $30,000. And that's where I need to be because of my salvage value. Okay, so the trick with double declining balance is you're going to do straight line times 2, straight line percentage times 2. Okay, you're going to use book value, not cost minus salvage, and watch your salvage value at the end of the life. Okay, so these are the things you've got to pay attention to. Straight line percentage times 2, book value, not cost minus salvage, and watch your salvage at the end of the life to make sure that you don't record too much depreciation. That's why I kind of like this format, because this format kind of shows me that I'm approaching, right? And then that way I can make sure that my last year of depreciation is not too high. So just to go over, let's do the journal entry for year 5. So we'll say 12/31. We'll say 05 for year 5. My entry would be depreciation expense. And accumulated depreciation, because these are always the accounts that I'm using. Debit and credit. So I'm going to debit the expense, 4992, credit accumulated depreciation, 4992. And that's it. That's all you have to do. Just watch for that salvage value. That's usually when I see students get it wrong. That's the part they get wrong.